In the first 3 months of 2026, the national purchase mortgage market actually shrank. I mean, origination volume across the whole industry declined by about 1%.
Yeah, it was practically frozen. Buyers and sellers were just stuck.
Exactly,
Yeah.
stuck in the mud. Yet somehow, Zillow's mortgage revenue just absolutely exploded by 56%.
Which is wild when you think about the macro environment.
It really is. So today, we're looking under the hood to see how this one real estate tech giant is honestly practically printing money right now.
Pulling off, what was it, 18% top-line revenue growth?
That's 18%, hitting $708 million in a single quarter, all while everyone else is just totally stalled. So welcome to the deep dive. For this one, we're digging into the financial results, the slide decks, and those dense shareholder letters from Zillow Group's first quarter of 2026.
There's a lot of material there, too, a lot to parse through.
Oh, for sure. So, okay, let's unpack this. Because if you want to understand how a company defies macroeconomic gravity like this, you have to look at how they've completely fundamentally rewired their business model.
Right. They aren't just a search engine anymore.
No, not at all. Zillow is not operating as a traditional real estate billboard anymore. They've essentially transformed into a vertically integrated, high-conversion funnel.
And that structural shift is really the only way to reconcile the numbers we are seeing, like a traditional digital billboard model that relies purely on maximizing top-of-funnel traffic, right?
It's just selling eyeballs to advertisers.
Based selling eyeballs. But a vertically integrated funnel is entirely different. It is engineered to capture a user, analyze their intent, sort them based on, their readiness to transact.
And then pull them down.
Yeah, seamlessly pull them down to the bottom of the funnel where the real monetization actually happens. So when we look at this Q1 data, their revenue surge has almost nothing to do with expanding their overall raw traffic.
Right. It's about what they're doing with the people already there.
Precisely. It is entirely about what they're doing with the specific people already inside that ecosystem.
Which honestly brings us to this massive paradox right out of the gate. Before we even get into how they are monetizing these users, we need to look at the traffic data, because the numbers in this shareholder letter seem to directly contradict themselves.
So, the internal versus external tracking.
Yes. So internal metrics show that traffic to Zillow's mobile apps and sites actually decreased by 3% year over year. They recorded 220 million average monthly unique users, and overall visits were down 3% to 2.3 billion.
Which sounds like bad news on paper.
Right. But then we have Comscore data. And Comscore is an independent third-party tracker that monitors the entire web ecosystem. Comscore says Zillow's average monthly unique visitors to their mobile apps and sites increased by 12%.
Up to 127 million.
Exactly. They are actually the only company in their category to grow their real estate audience over the past 6 quarters. So if you're listening to this and thinking, wait, how can they have fewer site visits but a growing audience?
Sounds like someone is just making up numbers.
It totally does.
But what's fascinating here is the difference in methodology between those two metrics. It actually tells us a lot about the psychology of today's home buyer.
How so?
Well, Zillow's internal tracking logs total session volume. So every quick open of the app, every casual ping when you're just bored on the couch.
Oh, so just window shopping.
Exactly.
Yeah.
Comscore, on the other hand, measures distinct individual users across a given time frame. So when you see total visits drop, but the number of distinct human visitors rise significantly, you are seeing a change in behavioral frequency.
Okay, that makes sense. Because in a booming market, people are checking the app constantly.
Right. In a low interest rate environment, you have users opening the app 5 times a day, just scrolling through listings for entertainment. The session volume is astronomical. But in a highly constrained, expensive market like early 2026, that casual browsing behavior just drops off a cliff.
Yeah, the people who aren't serious just log off. But the buyers who absolutely have to move, because of a new job, a growing family, whatever, they're still in the market.
They don't have a choice.
Right. And what the Comscore data is showing is this massive consolidation of those high-intent buyers. They are abandoning the smaller, fragmented regional sites, and they are flocking to the most dominant platform.
They're essentially saying, if I have to navigate a housing market this brutal, I am only going to use the biggest tool available.
Consolidation really is the key word there.
It is. Zillow is capturing a larger share of a shrinking overall market. They have fewer casual daily sessions to process, but a 12% larger pool of distinct, highly motivated individuals entering the top of their funnel.
Okay, so they have this concentrated, high-intent audience. The question then becomes, how are they extracting so much more revenue from them?
And that takes us straight to their core for sale business.
Yeah, because their entire monetization strategy there has undergone a massive evolution. The for sale segment as a whole grew 12% to $514 million.
Which is huge.
Huge. And within that, residential revenue hit $450 million. That's an 8% bump, driven by products like Zillow Preferred, Zillow Showcase, their agent software suite, and the new construction marketplace.
But the really interesting part is what they are actively killing off.
Right. Looking through the shareholder letter, the detail that jumped out is their intentional phasing out of their legacy market-based pricing segment. They are actively letting that revenue stream decline.
Just to prioritize their preferred partners.
Exactly. Why would they intentionally kill off a revenue stream like that?
This is perhaps the most significant strategic pivot in their entire history. The legacy market-based pricing model was essentially a raw lead generation business.
Like just selling a phone number.
Exactly. A user clicked contact agent on a listing, and Zillow sold that raw contact information to whichever agent bid the most for that zip code. Zillow made money up front, but they had zero visibility into what happened next.
So they didn't know if the agent even called the buyer.
Nope. Did they call? Did they
Okay.
close the deal? Zillow didn't know, and honestly, financially, they didn't really care.
Wow.
But the preferred partner model changes everything. They are now going much deeper with a smaller, highly vetted group of top-performing agents.
And they're requiring those preferred agents to use Zillow's proprietary software tools to actually manage the transaction.
Precisely. By forcing the integration of their software, Zillow retains visibility throughout the entire life cycle of the home purchase. They aren't just tossing a lead over a fence anymore.
Or holding on to it.
Yeah, they are tracking the engagement, optimizing the follow-up, and ensuring that the high-intent buyer they captured actually makes it to the closing table.
Okay, here's where it gets really interesting. Because retaining that visibility is what unlocks the ultimate prize. The absolute shocker in this Q1 report is not the 8% residential growth.
It's the mortgage revenue.
It is the mortgage revenue. It surged 56% year over year to $64 million. And that's driven by a 96% increase in purchase loan origination volume.
96%, almost doubling.
They hit $1.5 billion in loan originations.
Right.
And remember, the national market shrank by 1%. But Zillow's originations nearly doubled. And it is entirely because of that software integration we just talked about.
Yeah, when Zillow integrates their software with those preferred agents, they gain the ability to introduce financial products organically, right at the exact right moment in the user journey.
So the buyer isn't leaving the Zillow ecosystem to go find a local bank.
No, why would they? The user interface prompts them to get pre-approved through Zillow Home Loans just to tour a property with a preferred agent.
They are essentially removing all the friction. I mean, think of the analogy. Instead of just handing you the menu and hoping you figure out how to pay for the meal, they are financing the meal themselves.
That's a great way to put it. And monetizing the mortgage is exponentially more lucrative than selling a $50 lead to some random real estate agent.
Oh, absolutely. They're attaching a massive financial product directly to the search behavior.
The unit economics of a captured mortgage just completely transform the profitability of that single user. It really is the ultimate realization of the funnel strategy.
But, this strategy only works for the users who actually pull the trigger and buy. We are looking at a market with high interest rates, low inventory. Millions of people are just simply priced out.
Or they run the numbers and decide to sit on the sidelines for another year.
Right. So if Zillow's funnel is so efficient, what happens to the massive chunk of that audience that abandons the for sale path?
Well, they fall directly into the fastest growing segment of Zillow's entire portfolio.
Rentals.
Rentals, yes.
The Q1 data shows rentals revenue exploding by 42% year over year, hitting $183 million. And the primary engine here is multifamily properties, where revenue surged by an incredible 57%.
That's massive growth.
Zillow Rentals is now averaging 36 million unique monthly visitors. They boast 76,000 multifamily properties on the platform. That's a jump of 21,000 properties, or 38% just since Q1 of 2025.
If we connect this to the bigger picture, the rental segment is the perfect macroeconomic hedge.
A hedge against high rates.
Exactly. If a user gets discouraged by 7% mortgage rates and a total lack of starter homes, their need for housing doesn't just disappear. They still have to live somewhere.
And increasingly, that means renting in large multifamily complexes.
Right. So by building a dominant multifamily marketplace, Zillow ensures that a lost home buyer isn't a lost customer. They simply transition from the for-sale funnel right into the rentals funnel.
And they stay entirely within the Zillow ecosystem.
Exactly.
And to make sure they have the inventory to capture all those renters, they entered into this massive syndication agreement with Redfin.
Which is explicitly called out in the financials because it is not cheap.
No, not at all. The sources note a $50 million rise in the cost of revenue this quarter, and they attribute a significant portion of that to the expected higher lead acquisition costs associated with this specific Redfin deal.
And for anyone unfamiliar, a syndication agreement basically means Redfin automatically shares its rental listings to Zillow's platform.
It pools the inventory.
Right. But why does Zillow have to pay for that if it's mutually beneficial?
That's what I was wondering. Why pay for shared listings?
Because in a platform economy, inventory is king, but the platform that generates the actual signed lease demands the premium. Zillow is paying for the massive influx of leads that this expanded, syndicated inventory generates.
Oh, I see. It is a strategic expense.
Yeah, they're willing to take a hit on acquisition costs in the short term to ensure that if a consumer searches for an apartment anywhere on the entire internet, all roads eventually lead back to Zillow's database.
That strategy of aggressive expansion, it leads us to the financials. Because things get slightly counterintuitive here. You look at 18% overall revenue growth, 42% growth in rentals, 56% in mortgages. It looks like a flawless victory.
Oh, at the top line, sure.
Right. But total operating expenses and the cost of revenue reached $672 million. That's up 11% year over year.
And because of the costs associated with processing all those new mortgages, plus the Redfin syndication costs, Zillow's gross profit margin actually decreased.
Yeah, it fell from 76.8% down to 73.3%. So on a per-unit basis, the raw product is actually slightly less profitable.
The direct costs of delivering the service just went up.
But then you look further down the income statement at net income, and it soared to $46 million.
Which is incredible.
That's a 6.5% net income margin. That's up a staggering 520 basis points year over year. I mean, the prior quarter, their net income was a mere $3 million.
It's a huge leap.
So how does a digital platform see its gross margin shrink, but its net income completely explode?
It really just comes down to operating leverage in a digital environment.
Okay, so we aren't talking about a physical factory where the raw materials get more expensive. We are talking about, like, a digital toll booth.
A digital toll booth is actually the perfect analogy. Developing the software, building the app, establishing the server infrastructure, these are massive fixed costs. It costs an absolute fortune to build the toll booth.
Right.
But once the toll booth is built, the marginal cost of letting one extra car through is practically zero.
So even if the direct costs associated with acquiring a lead or originating a loan creep up a little bit, dropping that gross margin.
The sheer volume of traffic they are pushing through their fixed cost software infrastructure more than makes up for it. Yeah, they decreased share-based compensation by 16%, and they held the line on fixed expenses. Revenue grew by 18%, while operating expenses only grew by 11%.
So that 7% gap just falls almost entirely to the bottom line as pure profit.
Exactly.
But there is a glaring regulatory issue dragging down these numbers. Adjusted EBITDA, which measures, core operational profitability, it remained entirely flat at $182 million, sitting at a 26% margin.
And the shareholder letter makes it very clear why this didn't grow.
Yeah, they faced a 160 basis point headwind, meaning a 1.6% drag on their profit margins from $11 million in incremental legal expenses.
$11 million just in one quarter.
Just in Q1. And this is all tied to an ongoing federal trial with the FTC. If you exclude those specific legal bills, their adjusted EBITDA would have been $193 million. So they are effectively paying a massive ongoing toll just to fight the government.
Well, regulatory scrutiny is kind of the inevitable byproduct of market dominance. When you consolidate the housing search, the real estate agent software, and the mortgage origination all into one walled garden, federal regulators naturally take notice.
They definitely do.
But what is truly revealing here is how Zillow's management is handling their capital in the face of this trial.
And this is the part of the financial report I immediately wanted to push back on. Because Zillow's total cash and investments dropped from $1.3 billion at the end of 2025 down to $788 million at the end of this Q1.
That's a massive reduction in liquidity.
A huge drop. And they didn't spend it on some splashy acquisition or new technology. They spent $626 million to repurchase 13.5 million shares of their own stock.
A massive buyback.
Right. Wait, so you are facing an incredibly expensive, unpredictable FTC trial. You are navigating the most volatile interest rate environment in a decade, and you decide to burn over $500 million in cash to buy your own stock.
It seems risky.
To me, that doesn't sound like confidence. That sounds like a management team artificially propping up their stock price to appease Wall Street in the short term.
This raises an important question about capital allocation, and it is really easy to view share repurchases cynically. But the underlying cash flow metrics actually tell a different story.
Okay, how so?
You cannot artificially prop up a stock for long if the underlying business is bleeding cash. And Zillow's adjusted free cash flow for Q1 was a very healthy $127 million.
Wait, and that's up, what, 44% year over year?
Yes. They generated an immense amount of pure operational cash, partially because they didn't have to make that $100 million initial payment for the Redfin partnership that weighed down the previous year.
Oh, right. That was a one-time hit.
Exactly. They aren't borrowing money to buy back stock. They're using excess operational cash. It signals to the market that even with the legal headwinds, they believe their current valuation severely underestimates the long-term cash generation power of this integrated transaction funnel.
They're essentially betting the house on their own operating leverage.
Precisely.
So if they are this confident, what exactly are they promising shareholders for the rest of 2026? Looking at their forward guidance, they project Q2 total revenue to land between $750 million and $765 million.
Steady growth.
Yeah, they expect residential to maintain steady mid-single-digit growth, and they predict mortgages will hold flat after this massive Q1 surge. But rentals are forecasted to just keep tearing ahead at roughly 30% growth.
The continued reliance on rentals to drive top-line percentage growth proves that the multifamily strategy is no longer just a side project.
No, not at all.
It is a fundamental pillar of their long-term stability.
Definitely. And the real key to their 2026 crystal ball is the full-year outlook. They're guiding for mid-teens revenue growth for the year, but specifically projecting a significant expansion of their adjusted EBITDA margins in the second half of the year.
They outline a few specific levers for that, don't they?
Yeah, the shareholder letter outlines 4 levers they are pulling to make this happen. First, leveraging those $1.1 billion in fixed costs we talked about with the toll booth analogy.
Right. The system is built.
Second, a deceleration in variable expenses, which dragged down the first half by roughly 400 basis points. Third, they anticipate lessening legal expenses as the heaviest phases of the FTC trial finally conclude. Right, hopefully. And fourth, they are projecting a normalization of their advertising spend. In Q2, their ad spend is elevated by $16 million year over year, specifically to support new product launches. By the second half of the year, that just drops off.
That intentional structuring of expenses is a really classic operational tactic.
It looks like financial spring loading to me.
Okay.
I mean, they are taking all the heavy hits right now. They are absorbing the FTC legal fees, swallowing the Redfin acquisition costs, and paying an extra $16 million to market new software products.
Just compressing the spring in the first half of 2026?
Exactly. And as those temporary expenses evaporate in the third and fourth quarters, while revenue continues to compound at a mid-teens growth rate, that spring releases. It engineers a highly profitable back half of the year.
It demonstrates a level of operational discipline that you just don't always see in tech companies that are used to growth at all costs.
Right, the blitzscaling mindset.
Yeah. They are managing the machine over a 12-month cycle, accepting flat margins today to guarantee expanded profitability tomorrow.
So, what does this all mean? When you step back and look at the entirety of this Q1 shareholder letter, the narrative is crystal clear. Zillow has officially stopped being a real estate search engine.
They are a deeply integrated transaction machine now.
Totally. In a frozen housing market where origination volumes are shrinking across the board, they are nearly doubling their mortgage business by forcing software integration with their top agents and natively routing buyers into Zillow Home Loans.
And they're dominating the rental space by aggressively capturing multifamily inventory to catch everyone priced out of the buying market.
And they are generating enough free cash flow to eat millions in federal legal fees while simultaneously executing a $626 million stock buyback.
They have basically constructed an ecosystem that is entirely insulated from the macro housing market. Think about it. If interest rates drop and buyers flood the market, Zillow captures the mortgage.
But if rates stay high and buyers are forced to rent, Zillow captures the multifamily lease.
They win regardless of the weather.
They really do. But as you process the sheer scale of this vertical integration, there is a lingering thought we want to leave you with. We have outlined how Zillow is prioritizing a small group of preferred agents, forcing them to use Zillow's software, capturing the buyer's mortgage, and monopolizing the rental inventory.
It's total coverage.
Right. If Zillow continues to successfully capture every single piece of the real estate transaction infrastructure.
What does the future hold for the traditional independent real estate agent?
Exactly. As Zillow transitions into the underlying financial and software architecture of housing itself, do independent agents eventually lose their independence entirely? Do they become little more than gig workers, driving cars and opening doors, operating entirely within Zillow's walled garden while the platform captures all the real margin?
It's a profound shift in power dynamics. I mean, if the platform controls the buyer intent, the transaction software, and the financial product, the agent is no longer the center of the real estate universe. They are simply an outsourced service provider.
It is a fascinating, if maybe a little scary, reality to consider the next time you open the app to look at a listing. Well, thank you for joining us for this deep dive into the underlying mechanics of the housing market. We hope this exploration gave you some clarity on how the biggest players are rewriting the rules. Keep questioning the data, keep looking past the surface level metrics, and we will catch you on the next deep dive.